You get a statement in the mail. It doesn't look like much. A white envelope, your pension fund's logo in the corner. You almost throw it away without opening it. But you don't. And when you unfold it, the number on the page is reassuring. Your retirement account, the one you've been paying into for 30 years, is up again. Steady, the way it always has been. And somewhere near the bottom, in a block of gray text you don't fully read, there's a line about how part of your fund is now invested in something called private credit. Private credit. Somewhere in that gray text, a clock is ticking. To understand private credit, you need to understand what happened in 2008. The financial crisis was a masterclass in what goes wrong when banks get reckless. Lehman Brothers, mortgage-backed securities, subprime loans dressed up as safe assets. You know this story. What happened after is less talked about. Regulators decided that banks had been taking on too much risk with too little cushion. So they wrote new rules, specifically the Dodd-Frank Act, that made it far more expensive for traditional banks to make risky loans. The banks pulled back, and something had to fill the gap. Enter private credit. Private credit is exactly what it sounds like. Loans made not by banks, but by private funds, hedge funds, asset managers, private equity firms. They raise money from institutional investors, then lend it directly to companies. No bank in the middle, no public market, no disclosure requirements. Private. In 2000, this market was worth about $40 billion, a niche. By 2026, it is projected to exceed $2 trillion. That is a 50-fold increase in roughly 2 decades. To put that in perspective, the entire GDP of Italy is about $2 trillion. This market, which most people have never heard of, is now the size of a G7 economy. And the people running pension funds loved it. After the financial crisis, interest rates collapsed to nearly zero. Government bonds paid almost nothing. Stock markets were volatile. But private credit funds were promising returns of 8, 9, even 12%. All you had to do was accept one thing. You couldn't easily get your money back. That, they said, was the price of the premium. The pitch went something like this. These are loans to mid-sized businesses, boring companies. An auto parts manufacturer, a software firm, a dental chain. Not flashy names, just steady, cash-generating businesses that need capital to grow. Because private lenders move faster than banks and will take on loans that banks won't touch, they can charge higher interest rates. And those higher rates flow through to investors. Simple, safe, lucrative. But there's one more thing that made private credit truly irresistible to the people buying it. The funds could set their own valuations. Unlike a publicly traded bond, where the price updates every second on a screen for everyone to see, a private credit loan is valued by internal models. The fund decides what it's worth, and funds, as it turns out, are very good at deciding their loans are worth exactly what they paid for them. This is called mark-to-model, and it made the performance numbers look remarkably stable. One fund, Cliffwater, the largest operator of what are called interval funds, manages $33 billion in private credit. Since launching in 2019, it has reported a grand total of 3 negative months of performance. 3 in 6 years. Through COVID, through the fastest rate hiking cycle in 40 years, through bankruptcies across the very sectors it lends to. 3 bad months. You might believe that. Or you might start asking questions. Here's where things get structurally strange. Private credit funds don't just invest the money their clients give them. They borrow more money on top of that. They go to banks, real banks, regulated banks, and use their loan portfolios as collateral to take out additional financing. So what you actually have is pension fund money lent to a private credit fund, which borrows more against it from a bank, which then has exposure to a risky company it never directly chose to lend to. Leverage on top of leverage. JP Morgan alone had roughly $22 billion of exposure to private credit funds structured this way. Across all of Wall Street, banks had extended approximately $300 billion to private credit funds, according to a Moody's analysis in 2024. $300 billion of regulated bank capital, sitting underneath a $2 trillion industry that values itself. And the companies at the bottom of this stack? Most of those loans are floating rate. The interest payments move with the market. They go up when rates go up. When the Federal Reserve began raising rates in 2022, aggressively, historically fast, the monthly payment on every single one of those loans jumped. And remember, these were companies that were already considered too risky for traditional banks. Default rates among private credit borrowers hit 7% in 2023, then 8% in 2024, then crossed 9% in 2025. Each one a record, each one higher than the year before. Let's talk about what's actually happening right now, because this is where it stops being theoretical. Blue Owl Capital, one of the largest private credit managers in the world, quietly halted regular investor redemptions in early 2025. Too many people wanted their money back at once. The fund agreed to sell approximately $1.4 billion in loans just to meet the demand. In 2026, things started escalating. BlackRock restricted withdrawals from its flagship private credit vehicle after redemption requests crossed a threshold in $26 billion in assets. Locked. Then Blackstone, its private credit fund, reported record redemption requests, nearly 8% of its entire $82 billion fund in a single quarter. The fund returned a fraction of what was requested. Then Morgan Stanley. Investors tried to redeem 11% from one of its vehicles. Less than half came back. And then JP Morgan moved. JP Morgan, the largest, most profitable bank in American history, went through its portfolio of loans to private credit funds and quietly marked them down, reduced their stated value, which directly reduced how much money those funds could borrow against them. The bank's CEO, Jamie Dimon, said publicly the bank was being more prudent with certain categories of assets. A spokesperson called this routine. But other banks don't typically hold the same contractual right to revalue private credit collateral at will. JP Morgan had reserved that right, and it used it. Private credit executives told reporters they hadn't seen other major banks take the same step. When the most powerful bank on earth starts quietly admitting its collateral isn't worth what it thought, that's not routine. That's a signal. Meanwhile, a hedge fund called Rubric Capital sent a private letter to its own investors. The letter accused certain private credit managers of using what it called Enron-like accounting games, specifically cutting the cash distributions going to investors while simultaneously reporting stable performance figures on paper. The letter named Cliffwater directly, the fund with 3 bad months in 6 years. The $33 billion fund, whose first major investor redemption window of 2025 was opening just as the letter circulated. Rubric's conclusion: Cliffwater could be a canary in a coal mine and the first domino of many. And then, BlackRock wrote down a loan to zero. A company called Infinite Commerce Holdings, valued at 100 cents on the dollar just 3 months earlier, wiped out entirely. Not marked down, not adjusted, zero. This exact story has played out 3 times in the last 150 years. The details are different each time. The financial products have different names, the brochures use different language, but the core of what happens, the sequence of events, the way it starts and the way it ends, is identical every single time. 1873. Jay Cooke, a famous banker in America, had helped finance the Union Army during the Civil War. After the war, he turned his attention to building a massive railway across the northern United States, the Northern Pacific, and financed it by selling bonds to ordinary investors. These bonds didn't trade on any open market. Their value was whatever Jay Cooke said it was. In 1872, his own business partner in London sent him a private letter. It basically said, "You are using your investors' money to hold up the price of these bonds at a value no real buyer would pay. You need to go to the market and find out what they're actually worth." Jay Cooke ignored him. 1 year later, the illusion shattered. Jay Cooke's firm collapsed overnight, and when it did, it paralyzed the nation, forcing the New York Stock Exchange to shut its doors for 10 straight days for the first time in history. Within a month, 55 railroads had gone bankrupt. This was the birth of the Panic of 1873, a systemic seizure that dragged the country into a 65-month-long depression, marked by 14% unemployment, widespread bankruptcies, and years of intense labor unrest. Private loans, valued by the person selling them, no market to check the number. 1989. A man named Michael Milken worked for a small investment bank in California. He had a theory. Wall Street, he believed, had written off an entire category of corporate bonds as too risky, and was wrong. He thought those bonds were actually a good deal. For a while, he was right. He built a loyal group of buyers, pension funds, insurance companies, savings banks. They trusted him completely. One savings bank in California put nearly 70% of its entire deposit base into Milken's bonds, money that belonged to ordinary families, because the returns looked too good to question and the statements always came back clean. When Milken was arrested and his firm collapsed, the support system he had been running himself simply stopped. His buyers tried to sell their bonds and found out, all at once, what they were actually worth. Nearly a third of all savings and loan institutions in America failed, in what was known as the savings and loan crisis. The bailout cost taxpayers over $130 billion. Private loans, valued by the person selling them, no market to check the number. 2007. Banks took ordinary home mortgages and bundled them into complicated financial products. Then they sold pieces of those products to pension funds and large investors around the world, promising steady, safe returns. The ratings agencies gave the safest pieces their highest possible rating, as safe as a government bond, they said. These products weren't traded on any open market. They were valued using computer models built by the very banks that created them. The banks chose what assumptions went into the model. The model spat out a number. That number went on a statement somewhere. When the housing market cracked and the ratings agencies suddenly downgraded hundreds of these products at once, investors tried to sell and discovered what the models had been hiding. The losses spread to pension funds, insurance companies, and retirement accounts around the world, giving rise to what we know today as the 2008 financial crisis. Private loans, valued by the person selling them, no market to check the number. It's the same sentence repeated across history. Private loans, valued by the people selling them with no market to check the number. We have arrived at that moment once again. Nobody knows how this ends. Anyone who tells you otherwise is guessing. But here is what is worth watching. First, the redemption gates. When multiple large funds restrict withdrawals simultaneously, it creates a signal. Investors in other funds start to wonder if their fund is next. They request withdrawals preemptively. The cycle feeds itself. Second, bank exposure. JP Morgan moved first. If other major banks follow, if Citigroup, Goldman, Bank of America begin quietly remarking their private credit collateral, that's not an isolated adjustment. That's a credit cycle turning. Third, the defaults. A 9% default rate among private credit borrowers, rising. These aren't abstract statistics. These are real companies, real employees, real debt that cannot be repaid, sitting inside portfolios that may still be marked close to par. And fourth, the pension funds. The teachers and nurses and firefighters whose retirement savings were quietly moved into an asset class that promised safety and now can't tell them what it's worth or when they can have it back. Private credit may not collapse tomorrow. It may not collapse at all. It may slowly deflate over years, quietly destroying wealth in ways that never make a single front page. But when the largest bank in America starts admitting its collateral isn't worth what it thought, that's not a market adjustment. That's a confession. And confessions have a way of multiplying. You put the envelope on the counter. You make coffee. You go about your day. Somewhere in that gray text, the clock is still ticking. It was ticking in 1873. It was ticking in 1989. It was ticking in 2007. It's ticking now. Do you hear it?